It was one of the oldest and most respected banks in America, a financial giant with more than 150 years of history. But in 2008, Lehman Brothers collapsed in spectacular fashion, triggering a chain reaction that helped spark the global financial crisis. In this video, we're breaking down the shocking story of Lehman Brothers, how it rose to power, why it failed, and how its downfall shook the entire world economy. And trust me, the moment the bank filed for bankruptcy will leave you stunned. Before we dive in, don't forget to like, subscribe, and tap the bell. Because in the world of money, even the strongest empires can crumble overnight. The rise of Lehman Brothers. Founded in 1850 by three German immigrant brothers in Montgomery, Alabama, Lehman Brothers started as a cotton trading business. Over the decades, it evolved into one of Wall Street's most respected investment banks. By the early 2000s, Lehman had become the fourth largest investment bank in America, with over 25,000 employees worldwide and assets worth $613 billion. The bank's success was built on aggressive risk-taking and innovative financial products. Under CEO Richard Fold's leadership, Lehman embraced the mortgage boom of the 2000s with unprecedented enthusiasm. The firm originated, packaged, and sold mortgage-backed securities, earning massive profits as housing prices soared across America. The dangerous game of subprime mortgages. Lehman's downfall began with its heavy involvement in subprime mortgages, loans given to borrowers with poor credit histories. The bank didn't just facilitate these risky loans, it held onto them, believing housing prices would continue rising forever. This strategy worked brilliantly during the housing boom, generating record profits and bonuses. The firm's mortgage origination business grew exponentially. Through subsidiaries like BNC Mortgage and Aurora Loan Services, Lehman originated billions in subprime loans. More dangerously, the bank kept many of these toxic assets on its books rather than selling them off, creating a ticking time bomb within its balance sheet. Lehman also heavily invested in commercial real estate, accumulating a portfolio worth over $50 billion. The bank's leverage ratio reached dangerous levels. For every dollar of capital, it borrowed $30, amplifying both potential profits and catastrophic losses. Warning signs and ignored red flags. By 2006, cracks in the housing market were becoming visible. Home prices began stagnating, and mortgage defaults started rising. Smart money began pulling out of real estate, but Lehman doubled down. The bank's executives, blinded by years of record profits, dismissed warning signs as temporary market corrections. Internal risk managers raised concerns about the firm's exposure to real estate, but their warnings fell on deaf ears. The culture at Lehman prioritized short-term profits over long-term stability. Quarterly earnings became the ultimate measure of success, encouraging increasingly reckless behavior. Rating agencies, corrupted by conflicts of interest, continued giving Lehman and its mortgage products favorable ratings even as the underlying assets deteriorated. This false sense of security prevented the market from properly pricing the risks Lehman was taking. The collapse begins. In 2007, the subprime mortgage crisis erupted. Housing prices plummeted, and mortgage defaults skyrocketed. Lehman's carefully constructed financial empire began crumbling. The bank reported its first quarterly loss since going public, losing $2.8 billion in the second quarter of 2008. Desperate to shore up confidence, Lehman executives initially downplayed their losses. CEO Richard Fold claimed the worst was behind them, but the market wasn't buying it. The bank's stock price went into freefall, dropping from over $60 per share in early 2008 to under $4 by September. As other financial institutions like Bear Stearns collapsed or were bailed out, investors began questioning Lehman's survival. The bank's massive exposure to real estate made it particularly vulnerable. Credit rating agencies finally woke up, downgrading Lehman's debt and accelerating its debt spiral. The final weekend. The weekend of September 13 to 14, 2008, became known as the most dramatic 48 hours in Wall Street history. Government officials, bank executives, and regulators worked frantically to find a buyer for Lehman or arrange a government bailout. Bank of America and Barclays emerged as potential saviors, but talks collapsed over concerns about Lehman's toxic assets. Unlike Bear Stearns earlier that year, the Bush administration decided not to bail out Lehman Brothers. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke believed the market needed to face consequences for reckless behavior. This decision, meant to restore moral hazard, instead triggered global financial chaos. As Sunday night approached with no deal in sight, Lehman's fate was sealed. The bank that had survived 158 years of American history would file for bankruptcy at midnight, becoming the largest corporate failure in U.S. history. Global domino effect. The collapse of Lehman Brothers sent shockwaves across global markets. On September 15, the Dow Jones plunged 500 points in a single day, while credit markets froze entirely. Banks stopped lending to one another, gripped by fear and uncertainty. The world's financial system, bound together through complex derivatives and credit chains, began to unravel at alarming speed. The contagion spread quickly. European banks with heavy exposure to Lehman suffered crippling losses, while Iceland's entire banking system collapsed overnight. Investors fled emerging markets, draining capital and triggering currency crises. What began as a Wall Street problem spiraled into a global catastrophe. The economic fallout reached far beyond finance. Businesses suddenly lost access to credit for payroll and operations, forcing mass layoffs. Unemployment soared worldwide. Millions of families lost their homes, and retirement savings were wiped out. Governments scrambled to contain the disaster with unprecedented bailouts and stimulus packages, desperately trying to prevent the global economy from sliding into a full-scale depression. Lessons and legacy. The collapse of Lehman Brothers laid bare the deep vulnerabilities of the global financial system. Excessive leverage, weak regulation, and distorted incentives had created a financial house of cards that ultimately came crashing down. The fallout was so severe it forced governments and regulators worldwide to confront systemic risks they had long ignored. In response, sweeping reforms followed. In the U.S., the Dodd-Frank Act introduced new rules aimed at curbing reckless practices, while Basel III imposed stricter global standards on bank capital and liquidity. Banks today face tougher oversight, higher reserve requirements, and are required to prepare living wills to manage failure without taxpayer bailouts. Yet, critics argue that the core problems remain. Moral hazard, excessive risk-taking, and regulatory capture still cast long shadows over the financial sector. In many ways, the system is safer on the surface, but the underlying behaviors that triggered the 2008 crisis have not fully disappeared. From risky bets to worldwide chaos, the collapse of Lehman Brothers proves that one company's failure can change the course of history. What shocked you most about this financial disaster? Let me know in the comments. I'd love to hear your thoughts. If you enjoyed this deep dive into the 2008 crisis, hit like, subscribe, and share this video with someone who wants to understand how it all began. Until next time, stay curious, stay cautious, and never stop questioning the forces that shape our world.